Ever thought that owning a property means you're stuck with a huge tax bill every year? Well, think again. Now, it's no secret that real estate taxes are a part of property ownership, but it's time to debunk the myth that these taxes are merely burdensome. In reality, they play a crucial role in our society. Your tax dollars aren't thrown into a black hole, they're used to fund community services that we often take for granted. Think about it. Your local parks, libraries, schools, and even road maintenance are all funded in part by real estate taxes. It's easy to overlook these amenities, but they contribute significantly to our quality of life and the value of our properties. So next time you see that tax bill, remember, it's not just an expense. It's an investment into your community, and ultimately, your own property value. So, real estate taxes. They're not just a bill, but a contribution to your community. Real estate taxes may seem complex, but at their core, they're pretty straightforward. Let's dive right into it. Real estate taxes are essentially the price you pay for owning property. They are an unavoidable part of property ownership, and it's crucial to understand how they work. So, how are these taxes calculated? It's a two-part equation, really. The first part is the assessed value of your property. This is determined by a local assessor who evaluates the property's market value based on factors like its size, location, and the recent sale prices of similar properties in the area. Now, this assessed value isn't set in stone. It can fluctuate as these factors change, so it's something to keep an eye on. The second part of the equation is the tax rate. This is set by local governments and can vary greatly between different regions and even within the same city. For instance, a property in the heart of a bustling city may have a higher tax rate than a similar property in a rural area. Why? Because tax rates are often used to fund local services like schools, roads, and emergency services, and these services tend to be more costly in densely populated areas. So, to calculate your real estate taxes, you'd multiply your property's assessed value by the local tax rate. For example, if your property is valued at $200,000 and your local tax rate is 1%, you'd owe $2,000 in real estate taxes for the year. But remember, these figures can change. If your property's assessed value goes up, or the local tax rate increases, your tax bill will follow suit. Conversely, if these figures go down, you could find yourself with a lower tax bill. In essence, the more valuable your property, and the higher the tax rate in your area, the more you'll pay in real estate taxes. Understanding this can help you make more informed decisions about property ownership, and potentially save you some money along the way. How do real estate taxes impact you as a property owner or a potential investor? Let's dive in and unravel the effects of real estate taxes. As a property owner, real estate taxes can significantly influence the cost of owning property. These taxes are typically a percentage of the property's assessed value, and they can vary dramatically from one location to another. Now, if these taxes are high, they can substantially raise the cost of owning a property. On the flip side, if they're low, these taxes can make property ownership more affordable. For potential investors, the impact of real estate taxes is a bit more nuanced. High real estate taxes can eat into rental income or profits from property sales, making an investment less profitable. But don't let that scare you away. High taxes often mean that an area is well funded, which could translate to better public services, improved infrastructure, and a higher quality of life. These factors can increase property values over time, potentially offsetting the impact of high taxes. In contrast, lower taxes might mean more profit in the short term. However, it's essential to consider the area's potential for growth and development. Low taxes could indicate a lack of funding for public services and infrastructure, which could negatively impact property values in the long run. Then there's the matter of tax deductions. As a property owner or investor, you can deduct certain costs related to owning or managing a property, which can help offset the impact of real estate taxes. For instance, you might be able to deduct mortgage interest, property management fees, or even depreciation. In essence, real estate taxes are a critical factor to consider when planning for property ownership or investment. They can influence not only the cost of owning a property, but also the profitability of real estate investments. So, whether you're a homeowner looking to understand your tax obligations, or an investor seeking to optimize your investment strategy, it's crucial to keep an eye on real estate taxes. Remember, a savvy property owner or investor always factors in real estate taxes. Now that you understand what real estate taxes are and how they work, how can you make the most of them? That's the question we're going to tackle in this next segment. First and foremost, you need to actively manage your real estate taxes. This means keeping track of your property assessments. These assessments determine your property's value, and by extension, your tax liability. If your property is overassessed, you could be paying more than your fair share in taxes. Regularly review these assessments and challenge them if necessary. Secondly, take advantage of potential tax deductions or exemptions. For instance, many jurisdictions offer tax reductions for primary residences, homes with certain energy-efficient upgrades, or properties owned by veterans, senior citizens, or persons with disabilities. These deductions and exemptions can substantially lower your tax bill. In addition, consider the timing of your real estate transactions. The timing can potentially impact your tax liability. For instance, selling a property after owning it for more than a year could potentially qualify you for lower long-term capital gains tax rates. Moreover, if you're a real estate investor, consider strategies like tax-deferred exchanges. Also known as a 1031 exchange, this allows you to defer paying capital gains taxes when you sell a property, as long as you reinvest the profits into another similar property. That being said, everyone's situation is different. Therefore, it's essential to consult with a tax professional or financial advisor. These experts can provide guidance tailored to your specific circumstances. They can help you navigate the complex world of real estate taxes, from understanding the latest tax laws to planning for future tax liabilities. Real estate taxes, while unavoidable, need not be a financial stumbling block. With a proactive approach, you can potentially reduce your tax burden, making your real estate investments more profitable. With careful planning and professional advice, real estate taxes don't have to be a burden. They can be a manageable part of your financial landscape. So, arm yourself with knowledge, seek expert advice, and make the most of your real estate taxes. So, we've debunked some myths, broken down the concept, and given you some strategies to work with. Let's not forget the essentials. Real estate taxes are an inherent part of property ownership, calculated based on property value and local tax rates. They influence the cost of owning a property and the profitability of investments. But remember, with careful planning and professional advice, these taxes can be managed effectively. Remember, understanding your taxes is the first step to making them work for you. Until next time, stay savvy.